qualifying to buy a home, what you need to know in terms of positioning yourself to be able to purchase a home, regardless of what's happening in the market with interest rates, home prices, and everything. These are the essential things that you need to know to best position yourself so that you can purchase a home. So we'll get right on into the presentation. To start off with, there are a lot of different loan programs through which you can use to qualify for the financing to be able to purchase those homes. So we'll start off talking about a few of the traditional loan programs that you may have heard the names of. To start off, FHA. FHA has a 3.5% down payment. And so with an FHA loan, FHAs generally tend to be what's called a first-time home buyer loan because they have lower interest rates compared to conventional loans. And they also have lower interest rates, lower pricing, which is the cost that you pay for that individual interest rate. They also have lower qualification standards when compared to conventional loans. And the mortgage, but it's important to know that mortgage insurance is required on FHA loans. Now, FHA did earlier this year reduce how much their mortgage insurance is. Previously, their mortgage insurance was 0.85% of the loan amount, and they recently reduced that to 0.55% of the loan amount. So that would help a lot of people be able to qualify for a home or just save hundreds of dollars or even thousands of dollars a year on their monthly payments. So that was something that was a benefit that came out earlier this year. But that's the FHA loan program that a lot of people have heard of. Moving on to the conventional loan program, conventional loan down payments can be as low as 3%. Now, to get that low, you do need to be a first-time home buyer. But there are some programs on the conventional side as well, which will allow you to obtain that 3% down payment. Now, if you have at least a 20% down payment with a conventional loan, there is no mortgage insurance that is required. However, a lot of people don't put the full 20% down because 20% is a lot. For example, if you're buying a $200,000 home, that's $40,000 that you would need to put down to avoid the mortgage insurance. And a lot of people don't have $40,000 that they can put as a down payment, or they have that money that they need to keep in reserves for other purchases or for emergencies. Oftentimes for conventional, the appraisals can be easier than for an FHA loan. And so that's something to be aware of as well. I would not let that be the determining factor over which loan program you choose, but just something to make note of. And also, conventional loans can be used for second homes and investment properties. An FHA loan can only be used for a primary residence, but conventional loans can be used for second homes and investment properties in addition to primary residence as well. To get the 3% down payment, though, or really to get any down payment less than 20%, it has to be a primary residence for a conventional loan. So you can't get a second home or an investment property with 5% or 3% down or even 10% down. You would have to put that 20% down payment to get that investment property under a conventional loan. And lastly, I'll put under the traditional programs, VA and USDA. So with VA, I believe wholeheartedly that VA is the best loan program out there. There is no down payment requirement for a VA loan, no mortgage insurance required for a VA loan, and you typically get the best interest rates and the best interest rate pricing with VA loans. So VA to me is the icing on the cake. They are the best loan program out there. You also have USDA loans. USDA also does not have a down payment requirement. They do have a yearly guarantee fee, which is a fee that you pay to guarantee the USDA loan. It's a government loan or a government-backed loan. So rather than what you would think of as mortgage insurance, which you would see with your conventional and your FHA loans, a guarantee fee is pretty much similar to that, except they call it a guarantee fee and you pay that every year for the USDA loan. USDA is also only a loan that you can get for homes that are being purchased in certain areas. So you're not going to go downtown Atlanta and buy a home on a USDA loan. You're going to have to go a little bit further out in order to get that home for a USDA loan. So something to be aware of as well. So there are many different ways to finance a home. And depending upon your financial situation, depending upon perhaps your job or how you're paid or how you do taxes, may determine which loan program you want to use to be able to purchase a home. because you may be able to qualify through certain loan programs, but not through others. And I'll get a little bit more into the criteria, which could help you or hinder you from being able to qualify through certain loan programs. So moving to some of the non-traditional loan programs, bank statement loans, DSCR, which are debt service coverage ratio loans, no ratio, no income loans, condo-tels. Yes, that's a thing. If you have not heard of it, it's called a condo-tel, which is basically a hybrid condominium / hotel. So a condo-tel is a condominium that has all of the same functionality that you would have as with a hotel. So a concierge room service that you typically have with a hotel, you have that in a condo-tel as well. So with that, it allows people to be able to purchase a condominium, but also have it operate as a short-term rental if you wanted to. Let's say you purchase a condominium and there's part of the year that you don't want to stay there. Well, you can have it work as a short-term rental where the condo-tel has housekeeping or room service, concierge, and they will go in and clean the room for you after each visit and everything like that. So that's packaged into there as well. Obviously, that's going to come with some increased cost, but it is an option that's available, and usually to finance a condo-tel would come under a non-traditional loan program or a non-qualified mortgage. So barn dominiums, another term that you may or may not have heard of, but it is what it sounds like. It's a barn that's been turned into living space. So it's becoming more popular with people taking these external buildings or these barns and turning them into living spaces as their home. And so you can get financing for that as well. And so getting back a little bit into making sure that you get a loan officer that it has availability to a lot of these programs, but also is spending the time to learn your specific situation so that they can know what's the best route to take for you being able to get financed. Because again, the best route might be an FHA loan with 3.5% down, but let's say that you're self-employed and let's say you haven't filed taxes yet. And there's a delay there. Well, that might prevent you from being able to get an FHA loan or a conventional loan even, but it might not prevent you from being able to get a bank statement loan, because with a bank statement loan, we are just looking at your bank statements to qualify your income to be able to purchase the home. So you might be able to provide 12 months of bank statements or 24 months of bank statements. And we look at the income that's being generated or that's being received on those bank statements to determine whether or not you qualify for the loan. So we're not looking at your tax returns or anything like that. It is important to know that with these non-traditional loan programs, there are typically higher costs in terms of you will pay a higher interest rate more often than not, and you will pay a higher down payment. So as with that FHA loan, when you do submit those tax returns or those W-2s and those pay stubs for your job, with the non-traditional loan programs, a lot of times you don't have to submit those things, but you will pay a premium in terms of a higher interest rate. You will pay a higher down payment. You might pay 20% down payment for these non-traditional loans. You might pay a 25% down payment for these non-traditional loan programs. For example, a no ratio, no income, that's where you can purchase a home and we're not even looking at your income to be able to purchase the home. How crazy is that? There are loan programs out there where you can purchase a home without us even looking at your income. So what determines whether or not you qualify? We look at your credit score, because in a lot of these non-traditional loan programs, we do pull credit still. So we will look at your credit score to see how you are with your ability to manage and pay debt on time and keep that debt balance low. So we pull credit score. We also, for example, for the debt service coverage ratio loan, that's for investment properties. We look at the property itself and we look at the fair market value for what that property can rent for. And we use that to determine whether or not to do the loan, not so much your income. So we don't even look at your income with that. We look at how much that property could rent. So there are a lot of different methods and ways through which you can finance these properties. But it's important to know that there are some drawbacks with those pluses of not having to look at your income. You are going to pay higher down payments. So if you have a lot of money, sitting on the sidelines and your credit score is looking decent and everything, these may be options for you if you are not able to take some of the traditional loan program options. Do keep in mind, as I stated, the traditional loan programs will give you the better interest rate pricing and the lower down payments when compared to the non-traditional loan programs. But these are options for you to still be able to purchase a home, again, without having to provide W-2s, pay stubs, tax returns, or anything like that. So you can provide those things, but they are just other non-qualified mortgage loans that you can use to be able to get those homes. So moving on to closing costs, when we're talking about things that you need to prepare in order to qualify for a home, closing costs are one of those costs. So taxes and insurance, we typically rope those together, and we call those prepaids because they are being prepaid. So you have to have a year of insurance paid up when you close on that home. So you pay insurance for the following year. Taxes, we collect 2 months of taxes and 2 months of insurance and put that into an escrow account so we can start building up your escrow account to be able to pay taxes when they're due and be able to pay insurance for the following year as well when it's time to renew your yearly homeowner's insurance policy. Lender fees, attorney fees, and appraisals, those are also all part of closing costs. And these things can add up. Again, at the end, I will let you know about what you can expect to pay. I've got an example at the end as well for what you can expect to pay with closing costs and everything like that. But something that you need to be aware of and saving for as well. So with credit scores, getting back to the loan programs, specifically with the traditional loan programs, the minimum FHA score, and I've got minimum twice in there, so 500. Let me explain that a little bit. Typically, 580 is what I tell a lot of people, and this is the reason why. Once your credit score is between 500 and 579, you have to have a 10% down payment for an FHA loan. So that 3.5% down payment that you saw earlier no longer applies. When your credit score is between 500 and 579, you have to have that 10% down payment. So once you're at 580 and above, then you can have the 3.5% down payment. And that can make a world of difference. If you're purchasing, say, a $300,000 home, that's the difference between putting $10,500 down and putting $30,000 down. So that is that's a big difference, almost $20,000 difference in your down payment. So also, once you drop below that 580 mark, it gets increasingly difficult to qualify you for a mortgage. So when you are above that and that doesn't mean if you're at 580 that it's easy to qualify for a mortgage. It's just going to be easier than if you're below that 580 mark, and you're going to have an increased down payment requirement. And a lot of people who have credit scores that are below 580, perhaps in the 560s or 570s, a lot of times they don't have the down payment to cover a 10% down payment of the purchase price of the home that you're purchasing. So again, that's another barrier there as well. With conventional loans, you have to have a higher credit score. A 620 is what's required on a conventional. And I'll pause right there to say, these are FICO scores that we're talking about. If you look at your credit score through Credit Karma, that score is going to be different than what we use in the mortgage industry. In the mortgage industry, there are many different scoring models, and they all weight different items that appear on your credit report different. Which is why you have the difference in scores. It's why you can have a Credit Karma score and you might say, oh, I've got a 650 on Credit Karma, but then we pull your FICO score and we're like, well, we see a 590 on FICO. The items are weighted differently. How much you carry in debt is weighted differently. For example, if you max out credit cards, your FICO score might hit you harder for that because it's looking at your credit utilization, whereas your Vantage scoring model, which is the model that a lot of consumer products use if you're looking to get financing for, say, a store credit card or something like that, or if you're having your Credit Karma looked at, or if you're looking at your credit score through Credit Karma, they might show you the Vantage model, which is pretty common. But that Vantage model might look at that same maxed out credit card and say, okay, but you're making all the payments on time. So, yep, your credit card's maxed out, but it might not be hitting you as hard because you haven't missed any payments. Whereas on your FICO model, you might be hit a little bit harder because it's showing that you're having to depend on that in order for your living. Whereas credit should not be a dependence, but it should just be something that you should utilize when you need it in case of emergencies, but not that I have to live on borrowed money, which is essentially what credit is. So a little bit of difference in, if you look at Credit Karma, know that if you're not looking at FICO, then your scores that you're seeing are going to differ from what we show you. And you can know your FICO score if you wanted to know your FICO score. If you go to myfico.com, again, that's myfico.com, that will show you what your FICO score is, and that there is a cost to pay to look at your FICO score on myfico.com if you're wanting to see all three bureaus. But that will show you the same score that we will see on our side in the mortgage industry. So moving on from conventional, which again has a higher FICO credit score requirement than the FHA, we go to VA. VA has no minimum credit score requirement. Before you get too excited, most lenders put what are called overlays on top of VA requirements. And they can put them on top of any requirements. FHA has a minimum of 500. However, there are a lot of lenders that will not go down that low. So when a lender puts an overlay on top of a requirement for a loan product, what that means is that they're putting additional requirements on top of what the standard is that FHA or Fannie Mae or Freddie Mac has set for conventional loans. So if FHA says you can go as low as 500, a lender can come in and say, but we're not going to let you go any lower than 580. And that is perfectly fine and perfectly legal. They don't have to go as low as FHA is willing to go. But you have lenders out there that will. Now, with VA not having a minimum, most lenders will not let you slide by on a 460 credit score or whatever it may be. Most lenders will bring their minimums up to whatever, for VA loans, to whatever their minimum is for an FHA loan in many cases. So you need to check with your lender on that to see what their minimum is if you're looking to do a VA loan. But a lot of them will have minimums. So even though VA does not have a minimum, most lenders will have an overlay that does have a minimum attached to it. So with USDA, their preferred is 640. It is, again, more difficult to get an approval for a USDA loan, which, again, is for more homes that are located in more rural areas. They prefer a 640 minimum credit score. They don't have a minimum as well, similar to VA, but they do list what their preferred is. And once you get below that, there's additional documentation and items that are required in order for you to get an approval for a USDA home. So with non-traditional, it can vary depending upon the program and depending upon the lender or the wholesaler that is backing these non-traditional loans. So sometimes those minimums can be 620, sometimes they can be 660. I've seen them at 680 before. So it really all depends on who the lender is that is doing these non-traditional loans, or who the broker is, a mortgage broker that's doing these programs, in order to determine what that minimum score is. But just know that it can range, and oftentimes it's going to be 620 or higher in order to be able to get approved. So you need to have higher credit scores when you're taking a non-traditional route. Again, a large part of that is when you're using non-traditional means to qualify for a home, there are additional risks that a lender is taking on when they accept that loan application and approve it. They are not looking at, if they're not looking at your traditional income, whether it be W-2s or tax returns, that's a risk they're taking on. So in order to compensate for that risk, that's why they have a higher down payment that they require for you to pay in order to be approved for the loan. That's why they have a a higher credit score requirement that they have to show that you are better with being able to manage and pay off debt. It's why they have higher interest rates, because again, there is a lot more risk involved in these non-traditional credit items or non-traditional credit loans. And so with that, the lender wants some sort of compensation with all this additional risk that they're taking. And so the higher interest rates, down payments, and higher credit score requirements are ways that they help mitigate those risks. So how do you position yourself? The first item listed on here is first for a reason. Paying all your bills on time is the number one thing that you can do to help position yourself to be able to purchase a home. And this factors directly into your credit score. If you pay all of your bills on time, that's going to help out your credit score. Paying down your credit cards to at least 1/3 of what your credit card limit is also going to help out your credit score, but pay everything on time. If you find that you've hit hard times and you need to, there's a month where you're not able to make that credit card payment, or you're not able to make that light bill or a cell phone payment or whatever, talk with the creditor first before you just blow past that monthly payment. And here's why. If you have a credit card payment coming up and you're not able to make that payment, once you blow through that payment, it now gets reported to the credit bureaus as a missed payment or a late payment. That hurts your credit score. And that's something that can drop your credit score significantly, particularly, let's say if you're floating around at 700, I've seen one missed payment drop people 40 points before on their credit score. It can hit you hard. What you do is you go and talk to the creditor first and say, hey, I've hit a little bit of hard times right now. I'm not able to make my credit card payment this month. And see what they can do to work with you. Sometimes they can take that payment and they will just give you a break, so to speak, allow you to take a month break and then resume making your credit card payments on the next cycle. If it's a car payment, sometimes they'll take that payment and they can slide that payment to the back of the loan. So if you had, let's say, 80 more car payments to make and you can't make the next one, they can take that payment, so you essentially don't have to pay the next month. They will take that payment and slide it to the back of the loan so that you have that month break to get back on your feet and everything, and then start making those payments. And they can do that, and it does not report to your credit report or to the credit bureaus as a missed payment or a late payment, because in that way you can avoid having that hit to your credit, because you've shown more responsibly that, hey, I see that I'm not going to be able to make these payments. Let me reach out to the credit bureau, or let me reach out to the creditors, let them know I can't make this payment. Can you work with me? And a lot of times they will look at your situation. If you've been making on-time payments throughout the history of that credit card or that car payment or that car loan that you have, a lot of times they will work with you and say, yep, we will take that payment and shift it to the back, maybe double up on the next month's payment, whatever it is. A lot of times they will work with you and not report that missed payment or that late payment, but be proactive, let them know in advance. And that way you can avoid the hard hits to your credit. And one other thing that I'll say with that is that if it's for something that normally doesn't even get reported to the credit bureaus, make sure that you contact them as well. So cell phones are something that do not traditionally get reported to the credit bureaus. Utilities are something that don't traditionally get reported to the credit bureaus. So be proactive and take action if you see that you're not going to be able to make your cell phone payments. I have seen credit reports where someone's credit has been just completely dented by a $200 Sprint phone bill. Sprint doesn't normally report to the credit bureaus. However, if you don't pay your Sprint bill for long enough, or you don't pay your AT&T or Verizon or whoever your cell phone company is, they can take what you owe them and put it as a collection on your credit report. And so now what was not even showing at all on your credit, because cell phone bills don't show on your credit report. Now that's showing as a collection on your credit report, which is hurting you even more because it's showing as something that's being derogatory, something that's severely delinquent, so much to the point to where they now are reporting that as a collection, and that can hurt you. And you don't want a $200, $400, whatever it is, cell phone bill now showing up as a collection on your credit report, all because you didn't pay it. Now, if you're like, I didn't owe the money in the first place, here's what I recommend. I understand that it's going to be a lot harder to get your money back, if you already paid them the money, but I would recommend paying the $200 and still fighting that battle after you've paid the money, or the $400, or just paying it and cutting your losses. But I've seen so many people who are just fine having their credit destroyed because they are adamant about, I do not owe fill in the blank $300. And I'm like, for $300, we're not able to approve you for a loan to purchase a home because it's hurting your credit score to the point to where it's below where we can qualify you. If you would, just pay the $300, we could actually get you a home, and that home is going to appreciate to be so much more than what you're having to pay this company. So if you're able to get yourself to the place to where you can just pay them whatever they are owed or whatever they say they're owed, if it's not going to put you, set you back too much, my recommendation is to just go ahead and do that, because it will help save your credit score, and that's going to help position you for where you really need to be when it comes to being able to purchase a home. So moving on from paying bills, again, that was number one for a reason. But moving on, save, save, save. You want to save money because it's going to cost a lot of money. It's going to cost a whole lot of money to be able to purchase a home, more than what a lot of people realize. And I don't want you depending on down payment assistance. There are costs associated with everything, and down payment assistance is not free money. There are costs associated with it. With many down payment assistance programs, there are increased interest rates. With many down payment assistance programs, there are additional fees that are required in order to get that down payment assistance. And so be aware that don't depend on down payment assistance when it comes to purchasing those homes. You really do want to save up for your own down payment, save up for your own closing cost and everything like that. And so moving on from there, you want to have a good loan officer. For all the reasons that I mentioned earlier on in the presentation, you really do want to have someone in your corner that is not only knowledgeable about all of the loan programs that are out there, but is also willing to do their best work to match you with the best program that's going to give you the best interest rate. And the best interest rate, understand, might not be the lowest interest rate. Sometimes, especially depending upon the market and what your plans are in terms of perhaps refinancing in the future, maybe it's better to take a higher interest rate now, which is actually going to save you money up front instead of buying down that interest rate and spending $5,000 or $6,000 to buy down your interest rate to a 6% or 5.75%. Maybe you take the 7% interest rate now, save that $6,000 next year or the year after that. If interest rates drop to 5%, then you refinance and you spend that $5,000, then put that towards your refinance, and you're in a much better position rather than having to spend all this money up front to buy down your interest rate, and then interest rates drop below where you bought them down anyways. And now if you refinance, you're just losing money. So again, having a good loan officer who knows the market, knows the products that are out there, and can look into your situation to help you make the best decision in which is the best loan program for you to go forward in, because they all have a lot of different guidelines and requirements. And that will really pay dividends for you. Also, having a good real estate agent is going to pay dividends for you, and not just in the sense of a real estate agent who knows how to negotiate. You do want a real estate agent who knows how to negotiate, but understand that not every market is conducive, and not every home is conducive for a real estate agent to come in and negotiate $20,000 off the purchase price. That's just not feasible for every market or every home. There are some homes where you're not going to be able to negotiate off the price. And the best that that real estate agent can do for you is help you put in a strong enough offer in a multiple offer situation that will allow your offer to stand out above the rest so that you can get that home that you really want. Sometimes it's not going in and trying to lowball the sellers with a low offer. Sometimes it's going in at asking price. Sometimes it might be above asking price. Sometimes it's having a real estate agent that knows how to work with what they ask for from the seller in terms of what you're offering as well to help make that offer look appealing to the seller. Sometimes it's a real estate agent that knows how to work with a good loan officer to find out, hey, what are the costs to buy down this interest rate to a particular level? Because knowing what it costs to be able to buy down an interest rate is something that the real estate agent can then use when they are submitting that offer and saying, hey, perhaps we submit an offer for this amount, but then ask for the seller to reduce the purchase price or to contribute this amount. And then we can use that to buy down your interest rate so that the seller pays to get you that 6% interest rate rather than you having to buy it down or having to settle for the 7% interest rate. There are a lot of different things that you can do to work this, loan in your favor. And sometimes it's not shopping around for whatever the cheapest rate is, which is what a lot of people tend to do. They're like, oh, I'm gonna just rate shop and whoever can get me the lowest interest rate, that's where I'm gonna go with. The lowest interest rate might not be the best option for you. And again, a lot of loan officers can get you the same interest rate as another loan officer can get you. If I'm telling you that I can get you a 6% interest rate or a 6.5% interest rate, and you're like, oh, well, this other guy told me that he could get me a 5.75% interest rate. Well, did he also tell you that they're charging you 2 basis points to get that 5% interest rate, which is 2% of the loan amount? So a basis point represents a percent of the loan amount. So, or discount point rather, not basis point, discount point. So is he telling you that he's charging you 2 discount points to get that loan? So if you have a $400,000 loan and they're charging you 2 discount points to get that 5.75% interest rate, that's $8,000 that they're charging you to get that rate. So I can get you that same rate, but how many discount points are you going to have to pay? So knowing what questions to ask as well is going to help you compare apples to apples rather than just having some loan officer quote you a low interest rate, because you do have some lenders that will quote you a rate, but don't do the best job of explaining to you what it's costing you to get that rate. So you just hear 5.5%, 6%. And then this other guy told me 6.5%, 7%. But what was left out or what was not adequately explained to you is what it's going to cost you to get that 5.5% or that 6% interest rate. And so knowing that and having a good loan officer that can explain that to you is going to pay dividends rather than you just jumping on board with whatever the lowest interest rate is. There are other questions that need to follow that. What is your rate question? And what is your rate is not even the most important question. There are a lot of things related to service that I won't get into in this webinar, but you want to make sure overall that you have a good loan officer and a good real estate agent on your team. So like I said earlier, I was going to provide you with an example, and here is that example. So if you want to know how much you're talking about in terms of saving, $200,000 home under an FHA loan, your cash to close, and this is just based off of a example that I drew up in our loan processing system that we use, is $15,698. That's going to be your total cash to close for this $200,000 home under an FHA loan. So how do we get to that amount? Well, $7,000 is your down payment because FHA requires a 3.5% down payment for your loan. So $7,000 is your down payment. Prepaids, which are your taxes and insurance. 1 year of insurance has to be paid up front. And then we have to put 2 months of taxes and insurance in an escrow account. So we have to take that at closing as well. That's where that 3137 comes from. And then your closing costs, which are your lender fees and your attorney fees, amount up to 5561. And so that's how we get that $15,698. And this is on a $200,000 home. If you've been in Atlanta for any length of time, they are not plentiful in that price range. So you likely will be going up to a 300, 350, maybe even $400,000 home. And your down payment is going to be even higher. A $300,000 home, you're looking at $10,500 for an FHA loan. A $400,000 home, you're looking at $14,000 for a down payment. So things that you want to be aware of, this can easily be over $20,000, because if you save exactly $15,698, you are going to be broke after you purchase this home. And you want to have money for filling out this home, whether it be with furniture, appliances, or whatever. And you also want to have money for emergencies. What if you move into your home, but then something happens to your car and you need to get it fixed? You need to have money for that. So you don't want to save exactly the amount you need. You want to save more than that. And then at the bottom, as you can see, I put $1,772.49, which is your monthly payment for a $200,000 home at a 7% interest rate. And then the 1645.59 is going to be your monthly payment at a 6% interest rate. So that gives you an idea of what we're talking about in terms of how much you can expect to have to save total, and your appraisal is included in that 15,000 as well. So that includes everything for your total cash to close. So that's just an example to give you an idea of how much you can expect to spend if you were purchasing a home for $200,000. So lastly, you can do this. I can help you. Again, this is my passion. I love helping finance home purchases for individuals. So I can help you navigate the road to becoming a homeowner. And this is something you can do. Do not be scared away by the numbers. It may take some discipline on your part in terms of saving money, not spending it on things that you might not need, cutting back on those Starbucks runs, maybe cutting down on those streaming services. Instead of having 3 or 4 streaming services, maybe you have one, and take that extra 50 or 60 bucks that you're going to save and save that every single month. And you can start building towards being where you need to be in order to be able to purchase a home later this year, or this time next year, or in a year and a half from now. But in any case, get working now, because this is something that you can do. And it's something that I would take pleasure in being able to help you with. So